Tesla. If there's one stock, one name that is on everyone's lips, this name is Tesla. In the last few years, Tesla stock has become one of the darlings of the market, and since the bottom of 2019, its price multiplied by 13 times, greatly driven by low interest rates and by the green tech trend. After all, as the world is trying to move away from fossil fuels, electric vehicles seem to be the way to go, right? And so, Tesla's car became much more than a car. It became the future unfolding in front of our eyes, and buying Tesla stock became sexy, intelligent, and environmentally friendly. The hype was such that at its peak, Tesla reached an unbelievable market cap of $1.2 trillion. On the other hand, since then, the stock fell around 60%. Now, would this be the opportunity of a lifetime? Well, honestly, I don't think so. Actually, for me, this stock may drop even lower, like 50% lower. And in this video, I'm gonna show you why. So let's put a price tag on Tesla's shares. And to do this, we will use the discounted cash flow method. So as we can see here, in the last 5 years, Tesla has been growing at 37% per year on average, which is an outstanding pace. And last year, Tesla reached almost 100 billion on revenues. Now, do you think this kind of growth can continue? Let's be optimistic and say yes. So let's say Tesla delivers a 20% annual growth rate for the next decade, right? So this means that by 2031, Tesla's revenues should reach around $400 billion, right? Now, few companies in the world have revenues of such magnitude, but just to name a few. ExxonMobil is one of them, with around 340 billion in revenues, and guess what? Even being one of the major oil companies in the world, their market cap stands at $530 billion, which is still below Tesla's 550. Another company that is currently close to 400 billion in revenues, Volkswagen, with 350 billion in revenues. And guess what's their market cap? Around 70 billion. And I'm saying this just to give you a perspective of Tesla's current size and of what it means to have 400 billion in revenues. But let's say they deliver a 20% annual growth rate on average. Now, Tesla began to show positive operating cash flow in 2018, and since then their operating cash flow margin has been increasing considerably. It went to 21.4% in 2021, and then it declined to 13.7%, but in general, an upward trend. Now let's consider they will deliver an outstanding margin, like Ferrari, in the 30% area, right? 30%. Now, I don't think Tesla will be able to deliver this kind of margin. After all, Ferrari is Ferrari. Their brand is too strong, and its cars just have a lot of premium. Besides, the competition is also coming into the EV space. But anyway, let's be optimistic. Now, in this kind of business, you need a considerable amount of capex. After all, we are building cars here. This is not a technology company. This is not a software as a service company that needs to reinvest very little back into the business. So because of this, because they need to reinvest a lot back into the business, only around 36.5% of the operating cash flow becomes actually free cash flow, which is what matters the most, right? Now, let's say their free cash flow conversion rate stays at 50% for the next 8 years. Now, maybe that's a little too high, considering that their historical average has been 36.5%, right? But anyway, we are being optimistic here. So these premises will take us to a fair price of $223, which would represent an upside of 30.5%. Now, I would be happy to make 30%, but what's the downside? What's a reasonable price to pay for this stock if this company doesn't deliver the numbers we are projecting here. But before answering this question, if you are enjoying this video, don't forget to leave your like, and I also invite you to subscribe. But what if Tesla delivers more conservative numbers? What if their revenues grow at only 10% per year? And here you can see what happens. The upside is gone. Actually, now we are talking about a 30% downside. Oh, but there's no chance Tesla will grow at only 10% per year. Well, risk is exactly this. Risk is the possibility that what you anticipate may not occur. And in the first quarter results, we've already seen that revenues fell around 9% when compared to 1 year ago. So yes, revenues can grow less, and in fact, they can even fall. But let's keep 10% here. Now, what if they don't deliver a 30% operating cash flow margin? What if they just deliver a 20% operating cash flow margin instead, which is an already excellent result? And let's take into consideration that last year this margin was at 13.7%, so you can still argue that I'm being optimistic here. But considering 20% as our input, look at the price we reached, $82.5, which would represent a 51.8% downside. And I won't even change the projected free cash flow conversion rate here. Instead, I'm leaving this Excel sheet in this video's description so you can play with the numbers yourself, okay? But in summary, that's why I think Tesla's shares may fall 50% or even more, because this stock is just trading at very high expectations. Because think about it, even if Tesla falls more 50%, its market cap will still be around $270 billion, which is still huge. Now, both General Motors and BMW have around $170 billion in revenues each, and still their market cap stand at $50 billion, as we can see here for General Motors, and at $70 billion for BMW. Okay, these companies are much more financially leveraged than Tesla, which has more cash than debt on its hands. Tesla also grows much faster, but anyway, actually, if you sum up the market cap of all these companies, here, Volkswagen, General Motors, Ferrari, and BMW, even if you do this, you will only find half of Tesla's current market cap, which is for me an enormous red flag. So I don't see any reason to buy Tesla's shares today, especially when there are so many good companies out there trading for much more attractive valuations. For example, Vimeo or Payoneer, about which we've already talked about here in this channel. And by the way, nothing in this video was investment advice, okay? Well, that's it for today. See you next time.